Hello and welcome to Newscentre. With me, Parikshit Luthra. Just over 2 months left for the government to present its Union Budget 2023 and the countdown has officially begun. Finance Minister Nirmala Sitharaman has begun her pre-budget consultations. She chaired the first such meeting today virtually with industry leaders and experts from the infrastructure and climate change space. The Finance Minister will be meeting representatives from agriculture, financial, social, education, other sectors over the next 1 week. Meanwhile, the Confederation of Indian Industry has put forth its first leg of suggestions. Their key demands include reducing the income tax rates to boost consumption, reducing the 28% GST on select consumer durables to increase demand, raise capital spending to 3.3 to 3.4% of the GDP in FY24 from the current 2.9%. The CII has also suggested that no arrest or detention should take place in civil cases under criminalization in business has been proved beyond doubt. The CII has also sought withdrawal of windfall gains tax or special additional excise duty on domestic oil production. The CII wants government to target higher asset monetization receipts in the FY24 budget with a focus on railways and telecom sectors. It further suggests the government may consider a further stake sale in LIC. It also wants the government to avoid introducing any new subsidy schemes apart from PLI. The CII also wants the government to rationalize income tax slabs and rates for individuals at the lower end. Joining me now to take this forward is Sanjiv Bajaj, President of CII, and Vinayak Chatterjee, Chairman of CII, National Council on Infrastructure. Mr. Bajaj, if I may begin with you, one of the priorities that CII has laid out in its recommendations to the Finance Ministry is reviving domestic demand. What is the roadmap for that, according to you?
Good evening, Parikshit. And we must keep in mind that CII's own suggestions for the budget take into account the current state of the economy. Our government has helped us come through this pandemic, and we today are the fastest growing large economy in the world. But we have to also keep in mind that we are in a situation of global slowdowns and uncertainty, and we are already starting to see how that's impacting us, particularly we can see immediately in exports. So keeping that in mind, there are 6 areas in which today we talked about various suggestions. You've touched upon some of them, and I'm sure we'll speak about those in detail. Your particular point on boosting consumption demand. See, we are one of those few economies which have both the benefit of a very large domestic economy, which means very large domestic consumption opportunity that can keep the wheels of our factories running, and also an opportunity towards exports. Keeping in mind that exports are likely to slow down, and we've already started seeing that in the last couple of months, we believe that we can balance that with greater domestic consumption. Now, if you see the last, I would say 2 or 3 quarters, we can see slowdown in demand, consumer demand in 2 areas. One is in rural India, and the second is at the lower income level of urban India. Both completely understandable given what those segments have gone through the last few years. And this is where we have recommended that as far as the urban lower income consumer is concerned, we suggest rationalizing personal income tax slabs and rates at this lower end so that we can give them that much needed support, keeping in mind inflation as well, and increase their disposable income. In the same way, as far as rural India is concerned, we have suggested that as the government continues to focus on its capex investment, we would like to see a significant share of that going into rural capex so that there's rural job creation, which eventually will lead to rural consumption. So on consumption for the domestic economy, these are the 2 focus areas.
Right. Mr. Chatterjee, speaking about India's export story, which is likely to slow down because of global slowdown in trade and in some of the Western economies as well, which are some of the measures that you are recommending to the government in order to help India's industry tide over this slowdown in exports globally?
So let me give you an answer that is a little broader than your question, which is to say, to build on what Sanjiv Bajaj has already said, what are CII's recommendations to actually provide an impetus to the overall economy and thereby hopefully answer your question also, as exports being a subset of the entire economy. Now, Sanjiv made a lot of interesting points on CIIs, and in fact, CIIs pre-budget recommendation to the Finance Ministry covers enormous detail and runs into pages and pages of fairly detailed, minute points from policy to taxation. So I would like to step back and say, let's not, let's spend a few minutes looking not at the trees, but at the forest. And here I have, for the consideration of your viewers, 5 broad strategies, a 5-pronged strategy that CII has brought forward to the government as its recommendation, that by and large is the guiding principles of all other recommendations. So what are these 5? The first 5 fiscal recommendations. The first is a fiscal consolidation roadmap. So what we are suggesting is, in the last budget, a fiscal deficit of 6.4% was announced, and we are obviously saying that it would be nice that this figure is adhered to. However, going forward for the FY24 budget, we are recommending a fiscal deficit target of 6% and being followed up in FY26, FY25 with a 4.5% target. So this is our fiscal deficit target. The second point is on revenue augmentation. While there is certainly a bit of a feel-good factor on revenue buoyancy on GST account, we feel that government should have intensive focus on meeting its disinvestment targets, because this was announced earlier as a very major prong of, shall we say, fiscal policy. So aggressive focus on meeting disinvestment targets and a focus on higher monetization outcomes as per the national monetization plans. These are the ways that government can bring in revenues other than taxes. That was point number 2. Point number 3 is to broaden the tax base by, let's step aside and see that India's tax to GDP ratio is currently at 11.7%. And CII believes that we should now start targeting something close to 15 or 16% through better tax reform and broadening the GST base. So broadening the tax base. The fourth point is by rationalizing subsidies. Non-merit subsidies continue to be at a staggering 5.7% of GDP. In this case, it is states which are more at 4.1% and the center at 1.6%. But we believe the budget should take a frontal attack on rationalizing non-merit subsidies. And my last point on seeing the forest is which Sanjiv has already spoken about, which is an investment to continue pump priming the economy with an investment-led growth strategy and increase capex spending from 3.3% of GDP in FY24 to 3.8% in FY25 from current levels of 2.9%. Now, what that means for the infrastructure sector is we are advocating a further increase of 35% over last year's very, very robust increase of 35% that was witnessed last year. So last year, the increase in infrastructure allocations by 35% brought the level to rupees 7.5 lakh crores. We are saying do another 35% more and have a consolidated infrastructure budget in this infrastructure outlay in this budget of 10 lakh crores. And with that 10 lakh crores and with the states coming in and domestic and foreign private capital coming in, it would be easy to meet the national infrastructure pipeline targets. So these are the 5 broad strategic recommendations by CII under which many of the others fall. So the forest instead of the trees.
Right. Thank you very much, Mr. Chatterjee, for laying out that 5-pronged strategy for our viewers. So, Mr. Bajaj, you and Mr. Chatterjee in your opening remarks have really set the tone on what are the key demands from the industry. But if I were to ask you about specific pain points, possibly 3 pain points for the industry right now, which you would want addressed in some form in the budget 2023, what would those be?
Let's put it this way, Parikshit, instead of talking of particular pain points, because actually the industry overall has done reasonably well. We want to ensure the same level, if not higher growth in the coming year and thereafter. And that growth comes from not only small actions of today, but larger actions of today, which will have impact in the medium term. One, Vinayak has already talked about what we need for higher capex, what we need for greater fiscal deficit control. I would talk about generating jobs. This is one important area. And there are three suggestions there that CI has given. One is to start an employment-linked incentive scheme. So like we have the PLI for production link, to have an employment-linked incentive scheme for certain employee or employment-intensive sectors, whether tourism, logistics, retail, filming, gaming. That's one. Second is, there is a bill called the DESH Bill, the Development of Enterprise and Service Hubs. This bill replaces the SEZ bill. We believe that replacing that and creating the coastal economic zones will help to provide a fillip to India's exports. The world, imagine, is going through or going to go through a slowdown, possible recession. They will look for lower cost alternatives, and we can step up to doing that. Third, we have seen the significant success of Manarega in rural India. We have suggested a urban equivalent of that so that our urban poor get jobs as well. And this will help bring up their standard of living. That will help create consumption as well going forward. So employment and job creation is one important area. The second important area that I would like to focus on is consistency of corporate taxes. The government has done a great job by rationalizing taxes. And as CII, we've always said that do that. We will not ask for any exemptions, incentives, and true to our word, we have not done that. We believe that tax certainty for business should continue, and hence our corporate tax should stay where it is at current levels. In addition, further rationalization, simplification, ease of paying taxes, reducing tax litigation will just end up making business easier. A last important area that I would like to focus on, which can give us a 10-year runway, if not longer, is around climate change. India has proudly stood up to walk the talk on its climate commitments. And there are again three suggestions that we have made over here to the government. One is to set up a mechanism for green certification to help especially small and medium businesses access overseas green finance, which is now available in abundance. Large companies know how to certify themselves. But for smaller companies, we've encouraged the government to create a green certification process and through G2G engagement, create acceptance around that. Second is create a development financial institution purely for energy transition.
Right.
And third is, well, I'll just quickly finish, is on green hydrogen. So announce a PLI for electrolyzers and green ammonia and green hydrogen. So we believe with these, it should really give us a fillip, not only for short-term, but medium-term growth as well.
Right. Mr. Bajaj, I'd also like to ask you about CII's recommendations on indirect taxes. You're also calling for a withdrawal of the windfall gains tax and a graded roadmap for shifting duty slabs to a competitive level. Give us a sense of the priorities here when it comes to indirect taxes.
So the basic thinking over here, and CI has been talking about this for some time on indirect taxes, on import duties as well. When it comes to indirect taxes, is let's start rationalizing GST slabs now, get to the original premise of the one common slab and then one below and one higher. So that, you know, we just make the whole GST process simpler. We have seen now GST earnings go up month on month. A lot of the chinks have been removed in the last few years. And we believe that it's timely to do this. The greater you simplify, the more ease there is in doing business, because then people are spending less time on the complication of taxes and more on focusing on their own business. So it will be a step ahead. GST itself has made a big positive difference, and it will be a step ahead. As far as import duties are concerned, we've again talked about a simpler structure where if we want India to be a large manufacturing hub, then you go to a process where your lowest slab is on raw materials, and then you gradually move up to intermediates and finished products. So again, simplification, transparency, and sustenance of that is what will make a difference.
Right. Mr. Chatterjee, to the point on infrastructure, one of the recommendations is full and early implementation of the PM Gati Shakti master plan. When it comes to the infrastructure push, what kind of clarity, what kind of a boost do you expect from the budget?
Well, I already mentioned about the expectation of another 35% increase in allocation, taking it from 7.5 to 10 lakh crores. one of the major pushes that we are expecting is for urban infrastructure financing. Recently, there have been two seminal reports on urban infrastructure and urban financing. One is the maiden report by RBI on municipal finances. The other is a very large comprehensive report by the World Bank. And all of them point to strong interventions required to boost urban infrastructure financing. And to that extent, one of CII's recommendations would be or is to create conditions to create a very, very large and vibrant municipal bonds market. And there's a lot of detail there. But I would also like to take this opportunity to address the issue that you asked Sanjiv earlier on employment and livelihoods and investments. Now, I think Sanjiv made the point about moving ahead with the DESH bill, which is DESH is an acronym for Development of Enterprise and Services Hub, which replaces the existing SEZ bill. And I think we would strongly recommend that the DESH bill be clarified amongst interministerial confabulations and put into implementation. Sanjiv also made the point about coastal economic zones, and I want to underline that because in the first report that came out from Dr. Panagaria when he was CEO of Niti Aayog was to recommend labor-intensive, export-oriented thrust, and he had suggested a white paper called Coastal Economic Zones, which would be free of many of the regulatory hassles that bedevil Indian industry. And I would urge the government to take a look at that report again, as Sanjiv has said, and see if something can be done in pushing employment through coastal economic zones. Now, so far as labor is also concerned, during COVID times, we have seen the need to focus on migrant labor also, including construction labor. So I think CII would like to push to expedite a national registry of migrant labor with a focus on construction labor with attendant welfare, development, and monitoring packages. And the last point I want to make to add to what Sanjiv said is that government has been urging private sector to invest, which private sector is keen to do. And private sector in turn has asked for a facilitative, friendly, investment-friendly environment. And here I'm going to make a point about CII's recommendation about decriminalizing business-facing laws. So CII's recommendation is that all business-facing laws should be decriminalized with adoption of the principle that no arrests or detention should take place in civil cases unless criminalization in business has been proved. Now, this is important because India has such a maze of rules and regulations. We have 65,000 compliances and that require 6,500 filings. And therefore, the issue of decriminalizing business-facing regulations is very much in order. No arrests or detention should take place in civil cases unless criminalization in business has been proved beyond doubt. So these are some of the other recommendations that we have made to, create a degree of positivism in the minds of investors, both domestic and foreign, address the issue of migrant labor, labor-intensive growth, etc., etc. Over to you.
Right. Finally, to you, Mr. Bajaj, we're running out of time. But my last question to you, according to certain government estimates, and we're learning that this was communicated to the Parliamentary Panel of Finance a little while back, that if we want to become a $5 trillion economy by 26-27, and the timeline had to be extended to 26-27 because of the pandemic, we would need to have a 6.5% annual growth rate. Give us a sense of what we need to do now in order to achieve that $5 trillion economy. What does the budget need to do to keep the country on that path? And also, there has been concern in government quarters about private capex not really taking off, in private investment not really taking off. So what would be your suggestion on that front?
Well, Parikshit, we are expecting this year to be 7% and hopefully northwards of that. So let's talk about maintaining that growth of rate so that the $5 trillion target comes earlier rather than later. I believe a continuous focus on capex, clearly public sector capex from the government side, followed by private sector capex as well. And we are starting to see that in multiple sectors over the last 4-5 quarters. We saw that in commodities, we saw that in construction, logistics, chemicals. But yes, we have to see that in more sectors as well. So that's one, capex does make a big difference. Second, the employment generation that we talked about, this will make a big difference. And third is spurring domestic consumption. because we are talking of now a short window of time. So some of the other measures we talked about are more medium term for India, but for the short window of time, these would be the three areas that we would like to see the government focused on. And that is what actually the government has been doing in the last year or two, to be fair. So we have to just stay on that journey. And I believe that this will come in sooner rather than later.
All right, we've run out of time, but Mr. Bajaj, Mr. Vinayak, Chatterjee, thank you very much for joining us here on the budget consultations that are taking place at the North Block. Let's see what happens in the days to come. We're heading into a short break, but don't go anywhere. On the other side, we have Consumer Affairs Secretary Rohit Kumar Singh speaking exclusively to Timsi Jaipuria on the guidelines to curb fake reviews on websites. Welcome back. You're watching Newscentre. The government has released guidelines to curb fake reviews on websites. These guidelines, which have been developed by the Bureau of Indian Standards, will come into effect from 25th of November. Speaking to Timsi Jaipuria, Consumer Affairs Secretary Rohit Kumar Singh said the government will consider making these guidelines mandatory if self-regulation does not work and complaints continue. Take a look.
So there is a mechanism to filter out fake and non-genuine reviews. Paid reviews are admissible, but there has to be a disclosure. Like if you see the Google search engine, when you search something, the first 2-3 results will have an AD written as a prefix before the result. So that means it's an advertisement. So the user knows that this is an advertisement and the real search results start maybe from number 4. So similarly, if there is a paid review, if there's a third-party review, there has to be a disclosure. I think the key paradigm of this standard is disclosure.
When it comes to the conformity, it would take about a month's time to actually avail this certification. But in the meantime, how do you see these guidelines being followed by the industry? Will industry voluntarily comply to these? Have you got any assurance from the industry? Industry was consulted as well?
Yeah, of course, industry was consulted. And I would also like to clarify that we are not starting from scratch. Many websites already have systems to handle fake reviews. But we want a level playing field and we want everybody to be at the same page when it comes to a mechanism to handle fake reviews.
Yeah. What sort of a review did you get from industry, whether they wanted this to be mandatory to begin with or they wanted voluntary compliance?
The industry wanted it to happen. We have not discussed the mandatory and voluntary part because it helps the industry also, because it helps the menace of the adverse review inducement by the competitors. So it helps the industry. It's a win-win proposition for both.
When it comes to penal provisions, what are they?
The penal provisions are same as are for under the Consumer Protection Act and Central Consumer Protection Authority rules. So if a review is fake and it is established, then it falls under the category of unfair trading practice and the penalties will remain the same.
So you will make them mandatory in future, these guidelines?
We will see how it evolves, how it rolls out. If the self-regulation works and if the industry complies on their own, then there's no need of making it mandatory. But if we see a lot of non-compliance, a lot of complaints, then we'll have to go to the appropriate authority to explore whether it could be made mandatory.
All right, that was the Consumer Affairs Secretary speaking to Timsi Jaipuria on how the government will be tackling the menace of fake reviews. With that, it's a wrap on this edition of Newscentre. News continues on CNBC-TV18. Stay tuned.